Good morning, everybody. I'm Nicola Barrett, Chief Corporate Learning Officer at Emory Executive Education at Goizueta Business School. I'm very happy to welcome you to our Business Over Breakfast this morning. Recently, it's felt like the US stock market slips a gear every so often, dropping sharply as investors search for traction in tough terrain, and that terrain seems to be getting tougher every day. Our hearts and sentiments go out to all of those in Ukraine and those with family and friends in Ukraine. That's a shocking situation. Individual stocks in the major US stock indexes are down 20% or more from the peaks, from their peaks this year. And at the same time, we're all keeping a keen eye on what the Federal Reserve will do in terms of starting to raise interest rates again. So where do you turn to for a good investment yield? Here to answer this question for us today is Professor Roy Black. As a tangible asset with historically strong performance, Roy contends that real estate can offer a balance to a more volatile asset such as stocks and cryptocurrencies, and over time help drive performance for your portfolio. More specifically, REITs to the rescue. So Roy obviously has a sense of humor. Roy Black is a professor in the practice of finance and a director of Goizueta's real estate program, which has a significant alumni base. With a JD, an MS in real estate, and a PhD in business administration, combined with 15 years of experience as a real estate attorney, Roy brings a wealth of perspective to bear. But as they say, all work and no play can make Jack a dull boy. Roy is also, I understand, a musician and a painter. And Roy, you'll have to let me know, do you actually play the crumb horn and the cornemuse? Roy has a passion for music written prior to 1650. That would be 1650, like several hundred years ago. As is our usual practice, Roy is going to spend about 35 minutes teaching us about REITs and sharing some insights, followed by a Q&A session. So please, throughout Roy's session, put your questions in either the Q&A, preferably in the Q&A section. We'll also check the chat. I'd like to just plant a couple of seeds today for the end of our session. First of all, we partnered with Jamie Turner, who was featured on, I think, one of the February Business Over Breakfasts, and faculty member Reshma Shah on a leadership development research initiative. And we'd love to have you participate. So we're going to post a survey, a link to a survey, a leadership development survey in the chat at the end of the webinar. And we would, if you would fill that out, we would be most appreciative. Jamie is a great one for offering an incentive but for us to do things, but rather than his book this time, for anyone who completes the survey, they'll be entered into a drawing for one of two $250 Amazon gift cards. And if you're interested in leadership development for yourself or your team, we have several interesting programs coming up. Executive Communications and Leadership Presence is one. Our negotiations program, which you may need after listening to Roy this morning, is going to feature a new initiative, a VR negotiator that we've been developing over the last year. And so we're going to be having all the participants use that. So that's in partnership with an organization called Immersion. So you actually negotiate against an avatar. Also, at the end of the session today, there will be our usual short survey, so please also fill that in. Excited to have Roy with us today, and I look forward to gaining some insight into what I should be doing with my investment portfolio. Over to you, Roy.
Thank you, Nicola, and thank you, Pam, and thank you, Justin. I really appreciate being here today. This is my second turn on Business Over Breakfast. And I enjoyed the last time. I enjoy being here today. It's a great program, and I think it provides some valuable information to everybody who's here. Maybe not today, but usually. So, and I've attended a few sessions myself and been in the audience. Truly a great program. Thank you for being here, for me being here today. Okay, well, let me start out on a happy note. I know that Nicola has given you some of the bad news that the stock market is down. It has certainly taken a dive since the first of the year, and that includes REITs too, which I'm very happy for, because I'm always happy about the stock market, because when it's up, I'm making money, and when it's down, stocks are on sale, time to buy. So it's always a happy thing for me. Okay, let's get started. I've got quite a few slides to get through. So here we go. My topic for today is, dude, where's my investment yield? REITs to the rescue. I hope that over the next 30-35 minutes or so, I can answer that question for you, so that you'll be able to answer it. Okay, why is my slide? Here we go. I got to start off with a disclaimer. The information contained in the presentation is for your information only and does not constitute investment advice. You should do your own research. And any time I mention a particular stock, mutual fund, ETF, or company, or other investment product or services, that does not constitute an endorsement by me, Emory University, or any of its divisions, including Goizueta Business School, or Emory Investment, or Emory Executive Education. Any opinions expressed herein are solely mine and not Emory University or a subsidiary or programs. Okay, there we go. We got that formality out of the way. REITs. If I could see your faces on the screen, I would ask you to raise your hand, but we can't do that. But just do it anyway for fun. How many of you are familiar enough with REITs to be able to write down a definition on a piece of paper? Okay, nobody that I can see. How many of you are knowingly invested in REITs? Some, but probably not a lot. Okay, well, I hope to give you enough information in the next 30 minutes to, first of all, understand what REITs are, how they operate, why they are different from regular stocks that populate the S&P 500 and the Dow Jones, and then give you some research tools to go and research REITs, and then how to buy REITs, and a little short primer on how to evaluate them. A total session on how to evaluate REITs would probably take half a day or maybe an entire day. So I'm going to give you a shortcut. There's a website that you should be able to use to do some research, and it will get you started. And then I'm going to end up with how to get started in investing in REITs if you are an Emory employee and you want to invest in REITs or real estate. There are ways to do that. But generally speaking, in order to invest in individual REIT stocks, you have to go outside of pension funds, whether it's Emory or another type of pension funds, but we'll cover that. But two quick REIT key terms, because they will appear over and over and over again in just about everything that you'll read about REITs. And that is funds from operation and adjusted funds from operations. There are no totally accepted definitions of AFFO, but you'll see these. Here's a definition of adjusted funds from operations, and basically all this is the cash flow that is thrown off by rents. What we're going to be dealing with today are known as equity REITs. I'm not going to go outside the equity REIT sphere, because that's the most normal and frequent thing that people invest in when they invest in REITs. An equity REIT is a REIT that invests in the sticks and bricks properties for the purpose of throwing off rents and then growing the value of the property. So the AFFO, or adjusted funds from operation, is usually calculated by subtracting funds from operation, the net rents, both normalized recurring expenditures that are capitalized in the REIT and then amortized, but which are necessary to maintain a REIT's properties and its revenue stream. I'll stop here because it's a very technical definition, and every time you hear a technical definition, I don't know about you, it goes right over my head and I have to go back and read it later. Well, it's up on the screen so that you've got it. But I think the important thing to know is that real estate is different. It uses depreciation for tax purposes. And so the definition of the income is different than you would get from other types of investments. So you'll see FFO and AFFO, and sometimes they're used interchangeably, but basically it means the periodic income from real estate with some adjustmts. Capitalization rate. You're probably familiar with the term PE ratio, price earnings ratio, which is the relationship between, let's put this into a stock market context. The PE ratio is the relationship between the price of a share of stock and its earnings, essentially dividends. The capitalization rate is what we use in real estate, and it's really just the same thing, only the inverse. So if you had a share of stock that was $100 and it threw off $5 in dividends, we would say that the PE ratio is 20 to 1. 5 divided into 100. In real estate, the capitalization rate is just the inverse of the PE ratio. We would divide the 100 into the $5 and get a 5% capitalization rate. So it's using the same methodology to value a share of stock. It's just that, or not necessarily sometimes a share of stock and sometimes a sticks and bricks property. So when you hear that, the capitalization rate is just the same thing as a PE ratio. It's just the inverse. And for a more complete list of REIT terms, if you're doing some REIT research, reading it up on it, or you see a REIT term that you don't understand, go to www.nareit.com. Nareit is the National Association of Real Estate Investment Trusts. It's a trade organization for REITs, and they have a very nice section on definitions. So that's a good place to go for anytime you see a term that you're not familiar with. Some investment criteria, not continued, but investment criteria starting, and then we have another slide on investment criteria. Here are some things that you will see in articles that you'll read of how we take a look at and decide to invest in a share of stock or a block of stock. The price to FFO or price to AFFO ratio. And again, that's just the relationship between price and income. Dividend yield is the yield that the investor would get from periodic dividends. Most REITs pay quarterly dividends like a lot of other stocks, but there are some REITs that pay monthly dividends, and quite a few REITs are switching over to that now. People like the instant gratification of monthly yields. I do too. It's fun to tune in on the 15th of the month and see those dividends going into the account and know that they will compound over time. But that's what you get from part of your total yield. The other part of your total yield is the price appreciation of the shares of stock. Add those two together, and that's going to be total yield. AFFO growth or FFO growth is a very important metric, because if the FFO and AFFO are increasing, that means that, of course, your dividend is going to be decent. And also it gives the REIT an opportunity to accumulate money to go out and buy new properties and therefore increase its asset base. AFFO per share, another good metric. Of course, that's just exactly what it looks like. That is the amount of AFFO generated per share of stock of the REIT. CAGR, another important concept. It's compound annual growth rate. How fast is the REIT growing in terms of its sale price? Credit rating. You wouldn't think that this is that important maybe, but it's extremely important. For example, REITs are rated by the major rating industries or the major rating organizations such as S&P. And I just pulled out a stock that we'll take a look at as part of a theoretical portfolio later. Medical Properties Trust, which is a company that buys and sells hospitals, and their rating is BB+. The credit ratings are very important because the better the credit rating, the cheaper the cost of debt capital. And the cheaper the cost of debt capital, that means less money that the REIT has to pay for debt service. So up in the top line, you've got AFFO or FFO, and down the bottom line, you've got your cost of capital, which is both debt and equity. Now, if you have a bad credit rating, your interest rate goes up, and that squeezes the amount of income that the REIT enjoys periodically. So their credit rating is very important, and that's a metric that everybody should take a look at. Cash reserves. It's good for REITs to have cash reserves because opportunities typically come up in the REIT space where a company might get a chance to buy out a low-performing portfolio or to acquire new properties, and they have to move fast on it. So having a sufficient cash reserve to be able to make quick purchase decisions is important. So you'd want to take a look at that. I'm going to skip below that to line of credit. And just about every REIT has a line of credit that they can tap out. Most REITs do not buy properties using mortgages. You buy properties using mortgages. Other institutional investors buy properties using mortgages. They'll do the same thing that you do. Go to a bank or a lender, take out a mortgage and buy a property. Some REITs do that, but most just rely on their credit ratings, which is why the credit rating is important. What they will do is go to the market and borrow based on their credit rating and get a line of credit. Now, the difference between that is if you get a mortgage, if you bought a house, you know that what this whole process is like. It's like pulling teeth. It takes, if you're lucky, it takes 30 days and maybe 45 or 60 days to close the mortgage. And that would also be the case with commercial properties. But if you're borrowing based on your bond rating, you get a line of credit, like whatever, $30–40 million. And you can close, you can have the funds in a day. You can call up Goldman Sachs or whoever is giving you your funding. They wire money into your bank account and you've got it to spend within 24 hours. So that's why most REITs use their credit rating and borrowing on their credit rating, not a mortgage, but out in the bond market. Borrowing cost, well, I've already covered that. You want to keep your borrowing cost as low as possible, so you want to keep your credit rating good. Something you want to take a look at, has the company ever suspended or cut dividends? And of course, that's normally a bad signal, but you remember what COVID is like and what COVID did to the marketplace back in 2020. A lot of very good REITs did cut or suspend their dividends at the time, so that's not something you should use as disqualifying. But if they cut their dividend during a good time or suspended their dividend, that doesn't send a good message. There are rating services that classify REITs according to this is a dividend king or a dividend whatever, a dividend super wonderful. And they keep a list of companies. How long have these companies gone without suspending or dropping their dividends? And so that's a good place. You'll see that in the literature. And that's a good thing to take a look at. Cap rates. Talked about cap rates. Basically, what you want a REIT to do is buy when cap rates are high. That means that there is pessimism about future cash flows, and that drives the price of the asset down. So, you know, you're familiar with the old investment advice, buy low, sell high. This is a variation on that. You want the REIT to buy when cap rates are high and low when they sell. Cap rates are low, that means there's a lot of confidence in future cash flows, and that drives the price of the property up. So buy low, sell high. Buy when cap rates are high, sell when they're low. More investment criteria. Leverage. How much debt should a REIT take on? Well, REITs are different than the market for sticks and bricks. If you go out and buy a commercial building, say an office building, and you buy the whole building and you own the building in fee simple, you can usually borrow about 70% on that. And I remember back in the 1980s, I saw 90, 95%, 105% in a couple of instances on commercial properties. That doesn't work in REIT world, because REIT world, publicly traded REITs are, you've got Wall Street analysts looking over the shoulder and they don't like too much leverage. I just went to a REIT seminar yesterday where the seminar leader cited the fact that the average amount of leverage on REITs now is about 35%. That means that they've borrowed an amount that's equal to 35% of their total value. And I would say by the time you get to 50%, the REITs are going to start getting punished by the Wall Street analysts. So actually 50% in this market is kind of high. So I would be a little leery of anything, maybe 45% or higher. And certainly if they're up around 50 or 60, I wouldn't touch anything like that. And also you should take a look at any factors that could lower future cash flows, such as supply chain disruptions. That's going on right now. And that's a factor that's affecting company cash flows. Also, inflation. There's a lot of stocks that are going to be just hammered by inflation, but not necessarily REITs. And I've got a slide coming up on that, so we'll talk about that later. Lease quality. You have to pay attention to the leases. And you can find this out by looking at publicly available information online and the reports of the company to the SEC, and a lot of this will be available on fidelity.com and Seeking Alpha and other sites. The lease quality. You want to take a look at duration, the duration of a lease portfolio. Generally speaking, the longer a lease is, the better, because you've contractually got your tenants under a long-term obligation. But if the lease is payment of a flat rent, that rent is constantly being eroded by inflation. So a 10-year lease with no escalations is not a good lease. But REITs are pretty careful about that. And most long-term leases will have either percentage escalations, 1% a year rent escalation, 2%, or what you'd really like to see is a CPI escalation. So each year the tenant's rent would go up in an amount equal to the increase in the consumer price index, and that would keep the purchasing power of the dollars level. So take a look at the portfolio and find out what percentage are inflation indexed and what percentages are fixed, and at what percent, or if it's a flat rent. I don't know, that would turn me off on that. REIT something awful. The AFFO payout ratio, and that's exactly what it says. What is the AFFO? Well, I'm going to deal with this a little bit later because there's something confusing about how much REITs have to pay out. I'm covering that in a subsequent slide. Debt coverage. Debt coverage is the relationship between free and available cash and the amount of debt payments, and it's usually expressed as an annual ratio. So you want to make sure that there is an adequate cushion in the income that's more than enough to cover debts. In individual properties, we refer to that as DCR, debt coverage ratio. And if I'm either an investor or a bank, I would like to see debt coverage ratios of about 1.3. In other words, there is 30% more available income than you need to cover the debt. Anytime you get down below 1.0 and you've got a debt coverage ratio of 0.9 or 0.8, there's not enough cash to pay the mortgage and or make the periodic payments, and the REIT is in trouble. Cap rates, I've already covered that. High when you buy and low when you sell. Introduction to REITs. Okay, I'm going to skim through this because it's boring and it doesn't help you make any money, but it's stuff that you really need to know. So I'm going to go really fast, but you'll have a copy of this if you want to refer back to it. A REIT, or a real estate investment trust, is a company that owns, operates, or finances income-producing real estate. And it can be a mortgage REIT or an equity REIT. And remember, what we're covering today is equity REITs. REITs were created by Congress in 1960 to provide a real estate investment vehicle for small investors, such as you and me. And by the way, just an interesting little bit of trivia. The REIT Enabling Act was actually passed as an amendment to the Cigar Tax Act of 1960. Okay, I don't know how that happened, but it just emphasizes what Benjamin Franklin once said, that the two things that you should never watch being made are sausages and REITs. They're not sausages, they're sausages, sausages and laws. So that's a good example of that. Anyway, the early REITs were all mortgage REITs. They lent money, typically on construction projects. They were affiliated with banks, but they were separate entities. But the SEC, that's the Securities and Exchange Commission, not the Southeastern Conference, the SEC required decoupling from the banks in the early 1970s to avoid REIT losses attributed to the parent bank. Now, the banks were smart. They found this entity called a REIT, and they set up a REIT that they controlled, but because it was a separate entity, the losses weren't attributed to the bank and got them in trouble with the regulators in terms of their cash reserves and whatnot. Well, the SEC caught them and told them, no, you got to spin off the REIT. But by then the damage had been done. The REITs had made crazy, stupid construction loans that all, not all, but most of them needed to be foreclosed. And it was just blood in the water. My first big client when I was practicing law was a mortgage REIT back in the 1970s that had to convert to an equity REIT because they foreclosed on all their loans at, I think it was probably about, I don't know, 30 or 40 cents on the dollar. And this particular REIT in its heyday in the early 70s was trading at $35 per share. Then the price started to drop and trading was suspended on the New York Stock Exchange, and it was off trading for several years. And when it came back onto the market, it was selling at $1 5/8 per share. So all the way from $35 down to $1 5/8. And that was typical of REITs all the way across the country. So you can imagine how happy the investors were with their investment when it was down to about 3% of what, 2 or 3% of what they had originally invested. So anyway, REITs got a bad reputation and remained in that ditch until about 1991, when Wall Street took a look at this and said, hey, wait a minute, this investment vehicle makes sense. Well, the mortgage REITs had all converted to equity REITs because of the foreclosures, and some of those equity REITs started to do well. So we saw a rash of IPOs, initial public offerings in 1991, 92, 93, and REITs started to do well again. Their reputation was rehabilitated, and the same has continued through the present day. Here's an important one. REITs must pay out 90% of their profits to shareholders every year. Well, that's great. You know, a lot of these growth stocks, Tesla and whatnot, keep a lot of their earnings for research and development. The REITs can't do that. They have to pay out 90%. But this, I was referring to the payouts before. When you see some analysis on REIT stocks, you'll see their payouts are 82%, 84%, and you'll say, wait a minute, how can they do that if they're required to pay out 90%? That's because of depreciation. They're required to pay out 90% of their profits, but by the time you add in depreciation, which is a non-cash tax flow, that throws things off a little bit, and they're actually allowed to pay out less than the 90%. It's an accounting trick, but that's part of the industry. But that's still, you'd like to see a good payout, and certainly one that complies with the minimum. And there are even some REITs that pay out more than the minimum. You'll pick that up when you read the articles and the analysis. So essentially, this makes them dividend stocks, but there is upside price potential. I'll get into that later. REITs have both that good dividend component. The average dividend on a REIT is a little under 4%. The average dividend on a share of stock in the S&P 500 is about 1.3%. So the dividend yield on REITs is 3 times that of the S&P or the Dow. And also there's upside price potential. So that's one of the reasons why they're good. You get good cash flow in the meantime, and as a general finance principle, the sooner that you get cash flow and can reinvest it, the better. If you are waiting for a sale price out somewhere in the future, that is the riskiest cash flow of any investment. So it's nice to be taking in some free and clear cash during the holding period. REIT types. Equity REITs, we already defined those. That's what we're dealing with here. REITs are mortgage REITs that invest in mortgages. And there are also some public non-listed REITs, which are registered with the SEC but don't trade on stock exchanges. And also there are private REITs. Those are exempt from SEC registration and do not trade on national exchanges. So publicly traded equity REITs are our little bailiwick here. REIT asset totals. REITs collectively own $3 trillion in assets, with publicly traded REITs owning $2 trillion. I think REITs make great sense as an investment vehicle, and I think that the amount of asset totals are just going to go up over time. Equity REITs invest in a lot of real estate property types, including offices, apartment buildings, warehouses, retail properties, medical facilities, data centers, cell towers, infrastructure, timber, ground leases, triple net lease properties, and hotels. And that's not a complete list. If you want to venture out into some more obscure areas, they also do ground leases, and there's a whole category of sin stocks if you want to go there. Casinos and what have become very favored investment vehicles over the last couple of years. They're marijuana REITs that own the industrial facilities or agricultural facilities for growing marijuana. And here's a conversation starter for your next cocktail party. There's even a REIT that invests in strip clubs. Not me, but it's available if you want to take a look at it. I'll leave that up to you. Some REITs specialize in geographic areas like SL Green, which is an office REIT that specializes in New York, and Boston Properties, an office REIT that specializes in Boston. And some take a hybrid approach to their properties. That is, they may invest in primarily warehouses. They're an industrial REIT, but they also buy a lot of apartments. And so we refer to them as hybrid REITs. And that's a trend, by the way. A lot of the REITs, by the time they grow, it's hard for them to find good quality properties at reasonable prices within their specific space, and they go outside and find other properties. And actually, the hybrid REITs are typically doing pretty well, and I think you'll see that as a growing trend in the future. I took this out of NAREIT, as you can see down at the bottom. And of course, NAREIT is a trade organization, so they're naturally biased toward their clientele, which is REITs, but this is hard data here. Let's take a look at the returns over extended historical period. This is the FTSE NAREIT All Equity REITs, which is the name of the index. And we take a look at 1 year, and equity REITs over 1 year, 32.80%. Well, that's not too shabby. 3 year, it's returned 11.97, 5 year, 8.10, 10 year, 10.29. Whoops, what's that dip there? That was the Great Recession in 2008, 2009, 2010, and everything got hammered, everything. It's kind of amazing to me that REITs actually did close to 8%, but of course that was over a 15-year period. There was a lot of red ink in those 3 year periods. 20 year, 10.48, that's probably a pretty good benchmark. I would say that if you're going to use a benchmark to benchmark your own investment returns on, I'd say the 20-year benchmark of 10.5% is pretty good. And it's even done better over 40 years, 11.51. Let's take a look at an index for large cap stocks. The Russell 1000 did even better than REITs, 43.07 in 1 year. And if we go all the way out 40 year, notice that the return for REITs and the return for Russell large cap stocks is about the same. So why would you want to add something that had the same return and put that in your portfolio? Why not just go with an index fund for the Russell 1000 or the S&P 500? Well, I'm glad you asked that, and we'll talk about that more a little bit later. And of course, lagging in all of this is the Bloomberg Barclays US aggregate bond last year, minus 0.33, and bond indices this year are doing even worse, which I'll just jump ahead a little bit. The case that I'm going to make for REITs, and there's two bases to it. Number one, adding it to a mixed asset portfolio that is returning about the same thing. Why is that good? It's good because you get portfolio benefits. There's a slide coming up on this. REITs have a very low correlation with the Russell 1000 and the S&P 500, which means that by adding it to your portfolio, you are dampening the risk or dampening the variance and still getting about the same return. So there's a portfolio argument for adding REITs. And another one here is, now we're getting into the investment stuff. The return on bonds this year is even worse. I just looked up Fidelity Total Bond market this morning, and a 1 year return on Fidelity Total Bond, which is a mutual fund, or actually I think it's an ETF that buys bonds of everything from short to long-term duration. So essentially the bond market, the return for 1 year is minus 4.32%. Now, if you take a look on a lot of investing pages, you're probably familiar with the standard retirement portfolio, which is, or pre-retirement portfolio, which is 60% stocks, 40% bonds. Well, that may have worked fine during a growth era, which we're just getting out of right now, but that's going to be a loser in the future. If you've got 40% of your portfolio making minus 4%, that's a real turkey. Now, of course, inflation's running at about 7%. So you're losing money, but I guess you're doing a little bit better than sticking your money underneath a mattress. If you're sticking your money underneath a mattress and inflation is at 7%, you're losing 7% of the cash under your mattress every year. And if you're invested all in bonds at minus 4.2%, well, you're losing 4.2% of the cash in bonds, and you're taking a risk. So more on that later. But my fundamental thesis here is REITs are good for portfolio purposes, for lowering your risk. And also, if you have bonds in your portfolio, you might want to consider replacing some of the bonds or all of the bonds, that's up to you, in your portfolio and putting that money into REITs or wherever else you've got a non-performing asset or a low performing asset like certificates of deposit. I keep checking with my bank, and the certificate of deposit rate for a 1-year CD seems to be hovering about 0.15%, which means, if I invested $10,000 in one of their CDs at the end of the year, I'd probably have enough for a Happy Meal at McDonald's, and that does nothing for me. Well, I get a Happy Meal out of it, but that's not a lot of satisfaction. S&P sectors 2021 returns. Here we go. Here are the S&P sectors: energy, real estate, information technology, financials, healthcare, consumer discretionary, materials, communication services, industrials, and consumer staples and utilities. Well, notice where real estate is with the big blue arrow there. Real estate returned 42.5% in the S&P last year, and it was only beaten out by energy at 47.7. So there's another pretty good argument. And of course, the past is not a good predictor of the future, and there's no way that real estate is going to make 42.5% this year. I'll just tell you that. I'm not going to lie to you. It's going to be lower than that, but it's still going to be pretty good. Oops. What did I do? Ah. I'm sorry, I hit the wrong key. Let's, there we go. Inflation, that's a big issue right now. The investors and analysts in the stock market are all clutching their pearls and going, oh, inflation's going to kill investments. Not necessarily. From an investment standpoint, inflation is nothing more than an economic mechanism that shifts money from paper investments to real investments. And notice here's 4 different scenarios: high and rising inflation, low and rising inflation, high and falling inflation, and low and falling inflation. These cycles, these mini cycles, occur periodically a lot. For example, high and rising inflation occurred 10 times since 1988. During that period of time, REITs performed at 12%. Low and rising inflation, REITs performed at 12%. High and falling inflation, REITs performed at 17%, and low and falling inflation, 9%. We are at this sector over here in the cycle, low and rising inflation, and we're looking at 10%. No guarantee that it'll do that, but probably a pretty good, REITs are just not going to get clobbered by inflation. And the rising interest rates, part of a problem, but it's not a big problem. REITs can raise their rents during times of inflation because the replacement cost of properties is high. It will represent a problem if it gets high, but I don't think that inflation is going to, or excuse me, either inflation or interest rates are going to go to double digits. Quickly on this one, portfolio benefits. I mentioned this before. REITs have a low correlation with stocks. Here's large cap stocks. That would be the Russell 1000 or the S&P 500. And the correlation with REITs is down here. It's about 0.65. In other words, every time there's a change up or down of, say, one unit, of large cap stocks. There's only 0.65 with REITs. So it dampens the variability of returns in your portfolio. So that's a good reason for investing in them. What percent of your portfolio should be in REITs? Well, according to NAREIT and a lot of research, it should be up here in the right-hand corner, 5 to 15%. And I agree with that. So if you're going to invest in REITs, you obviously free to pick any percentage that you want, but a lot of research has shown that 5 to 15% is a good range. What investment criteria should you use? Oh, I wanted to warn you about this one. The highest yield? Nope. No. Terrible. For example, there is a REIT called APTS, Preferred Apartment Communities, which is an Atlanta REIT. Take a look at this. Here is the last year's return on APTS. Made 234.03%. You got to be kidding. That's phenomenal. It's also totally non-sustainable and really non-sustainable. Would I recommend this stock to anybody? No. There's a quote over here about one of my favorite authors, Brad Thomas, about going for high yields is a fool's game. There's always things going on in the background. And if you go to Seeking Alpha and read this article, warning, APTS is at a high risk of cutting its dividend and its safety grade is D. Come on, that's, yeah, of course, I wanted to give something contra here, fair and balanced. Looking for an inflation hedge, buy Preferred Apartment Communities REIT. So, you know, there's one thing that I noted here up the top. Investment authors often differ on their opinions. And here's an author that wrote just last October that APTS was a good deal. I am definitely not on the buy it side on this one. Should you invest in high yield or dividend growth REITs? Well, here is a graph that shows here are the highest yielding REITs, and over 1 year period, they returned 7%. Over a 5-year period, minus 17.1, and 10-year 48.1. And then take a look over here, and the dividend growers have a 20.3% yield over a year, 68.1 over 5-year, and 273.7 over a 10-year period. So I have some high yield REITs, but I mostly operate in the dividend grower space. But again, you read the articles and draw your own conclusions. Here's a quote from Jared Woodward of Bank of America Global Research. Dividend growth has consistently outpaced inflation since 1950, as it did in the 70s and 80s. Take that for whatever. How to invest in REITs, individual REIT stocks. Most company retirement funds, including Emory Universities, won't allow you to invest in individual stocks, but you can invest in mutual funds and ETFs, and that's more on that later. For individual stocks, you have to open up a brokerage account with an investment company such as Fidelity, Schwab, or Vanguard, or you can invest in one of these new companies that allows you to invest a really low minimum. I don't even know if they have a minimum, $25, $100, $200, and buy fractional shares. Here are the two research sources for you. I've already given you NAREIT, but here's Seeking Alpha, www.seekingalpha.com. And let me just introduce you to seekingalpha.com very quickly. I would highly recommend that you go and take a look at it. It is, I think, still free. At least my students are having no trouble getting on. So let's take a look at, you can construct a theoretical portfolio. Here's my theoretical portfolio. These are not stocks that I own. These are stocks that I'm watching. And you can get all kinds of information about each individual stock, what's its price, what's its day range. Here there are rankings by analysts off on the side. And in addition to setting up your own portfolio, you can mark articles by authors that you want to follow. And here, just coincidentally, here are the 3 authors that I follow the most. These are 3 authors that write about REITs, Yossi Ascola, Rita Morwa, and Brad Thomas. So I can filter out all the noise from the non-REIT stocks and just take a look at those authors. Now, let me go back and let's see, let's click on one of these, Brad Thomas, and So this is what one of the articles looks like, and you'll see lots of graphs. And the beauty of this website is they have pre-digested a lot of this information for you. You don't have to go to the corporate filings with the SEC or listen to the quarterly earnings reports. They will do it for you. They all interview the CEOs of the REITs, and they will do some comparisons, and sometimes they recommend the purchase of the stock, sometimes they don't. But this is about as comprehensive as you can get in a short bite, and it's all done for you, and it's free. Now, what the authors here are all trying to do, Brad Thomas and the others all have, see this thing premium up here? He is trying to sell you a premium subscription to his investment service. And that's a good thing, because if he doesn't give you good investment advice in the free articles, you won't subscribe to his premium service. I don't subscribe to the premium services. I just go with the freebies. I'm cheap, and I've done really well by taking a look at these. And let's go back to, well, let's not. We're kind of short on time, but definitely go and take a look at this. This is really good information. Let's go back to the. Okay, we're getting toward the end. If you don't want to buy individual REITs or can't, here's the list of things that you can do for Emory 403B retirement account investors, Fidelity Investments, Vanguard, and TIAA, which are our three choices. You can either set up a brokerage account, or if you don't want to invest in individual stocks, there are index funds for REITs, such as VNQ, which is Vanguard's ETF that purchases REIT stocks, 52-week performance 14.72, Fidelity, MSCI Real Estate Index, et cetera, et cetera. Now, what you're going to find is that these returns are a little bit lower, or a whole bunch lower, than you could do if you carefully picked individual stocks. The reason for that is when you buy an index fund, whether it's an S&P or a REIT index fund, it has either the whole or most of all the stocks that trade. All the S&P stocks will be in the S&P 500, and 170 of the 260 REIT stocks are in VNQ. So that means you're going to get the really great REITs, and you're going to get the dogs thrown into the portfolio. But if you don't want to do any research, you can do a lot worse than investing in index funds over the time. So I would just say, if you've got, let's say, a retirement portfolio that has the S&P 500 and some bonds, what you might want to do is take a look at replacing some of the bonds with an index fund for REITs. And by the way, you can't even do that in some of the Emory choices. You still have to set up a brokerage account, and you can only do ETFs and mutual funds, but you can still get them. It's not a big deal. And also, a lot of young people like this buy fractional shares from these companies, Interactive Brokers, Robinhood, et cetera. You can set up an account very cheaply and buy fractional shares. So you can have a 5-stock portfolio that costs you $200. It's a nice way to get started and a nice little hobby. One last way, and this is non-real estate, but I thought I'd throw it in to juice your portfolio. If you don't want to do REITs, or you want to add this to REITs in your portfolio, I-bonds, which is a US government security. You can buy them at treasurydirect.gov. They're currently yielding 7.12% per annum through April 2022. The rate changes every 6 months. The minimum purchase for electronic bonds is $25. The maximum is $10,000 per person per calendar year. My wife and I, every January 2nd or 3rd, go buy $10,000 each of I-bonds. Those are probably about the safest security you can buy, in addition to T-bills and other government securities. It's even safer than bank deposits, which are FDIC insured. If the US government ever defaults on its obligations, your investment portfolio is going to be the least of your worries. So these are pretty safe, and 7.12% is great. However, with inflation at 7% and these I-bonds yielding 7.12%, you're basically treading water. But you're treading water better than if you're making 3% in the bond portfolio or 0.15% in a bank CD. So this is kind of like a nice portfolio leveler that has a decent cash flow to it. And I'll leave it up to you. Go take a look at treasurydirect.gov and see if you are interested. An action plan with some variants. I'll go through this very quickly. This is there for you to review when you get a copy of this. First thing I would say is read up on REITs at www.nareit.com. It's a good short education on REITs. Subscribe to Seeking Alpha. I think it's still free except for the premium account because my students are having no trouble getting on. And start reading articles on REITs. Pick about 10 or so REIT stocks and put them in your My Portfolio account. Doesn't cost you a dime. Put them in My Portfolio in Seeking Alpha. You don't, not really buying them, you're just putting them there and tracking them. So that way you get a good track on the performance. And finally, when you feel you're ready, dip your toe in the ocean, set up a fractional share account, invest $100 or $200, pick 4 or 5 stocks, and at least get the thrill of knowing that you own some equities, and then maybe add $20, $30, $50 a month and watch it grow from the new deposits, the dividends that it throws off, and also the price appreciation. Or go all in and buy a REIT ETF for your retirement portfolio, or really go all in and start buying individual REIT stocks. So you got a lot of choices here. Construct a 3 or 4 or 5 asset portfolio. There are some interesting sites on YouTube that some of them are good and some of them are not so good, but you can get video suggestions, and you can actually input 3 asset portfolio in YouTube and get an analyst showing you how to do a 3 asset portfolio or 4 or 5. So you can get an idea of that. And also you already have some guidelines on how much REITs are ideal. So this should be fun. Now, I hope you enjoy yourself. And here's my take on hobbies. Obviously, as Nicola mentioned, I have some hobbies, music and drawing and collecting books and whatnot. And that's not a big negative cash flow. It's a small negative cash flow. And most hobbies are enjoyable, but they're all negative cash flows. So why not have a hobby of investing and make a positive cash flow? Just add that to your list of hobbies. And last but not least, you're not going to get rich quickly or overnight on REITs. It's a long-term play. So get rich slowly and sleep well at night. And every night before your head hits the pillow, you can say, tonight when I go to sleep, I'm making money. And I'm making good money that is going to leave me in good shape for my retirement. So I'll stop there. And I think it's, Nicola, it's about time for questions.
I think so. I'm sort of thinking, wow, that was a lot of information in a short period of time, Roy.
Sorry about that. I kept saying I'll shorten it, but it was a lot of important stuff. And I actually, there's about 60 slides I wanted to do, but I can't. So sorry for having to go fast, but I'm going to fall back on the fact that everybody who's here today is going to get a copy of the deck.
Okay, well, look, thank you so much. We do have a couple of, we have several questions. So hopefully we can answer some of them quickly. Actually going from the bottom up to the top. Gary asks, what's the difference between I bonds and US saving bonds, or are they the same thing?
Well, they're essentially the same thing. If you take a look at treasurydirect.com, there are all kinds of different bonds. I think these are different than traditional savings bonds. I've got a bunch of traditional savings bonds going back to the 1980s, and they're paper bonds. And I don't think you can buy them as paper bonds anymore, but all of the different categories of bonds that they have available are on treasurydirect.com. And I don't think these are standard bonds. They were specifically created to have 2 components. One is a basic interest rate, and on top of that, inflation. So they're not like traditional savings bonds, which paid a fixed coupon, like whatever, 4%.
Right, yeah. So can you quickly discuss the pros and cons of either investing in a REIT mutual funds versus individual REITs, other than obviously the time it takes for you to research which ones to invest in?
Yeah, well, that's really the big difference. And fortunately, we've got Seeking Alpha, where you can get pre-digested analytical information. It would be much more difficult if you had to go to the SEC filings and the company's website and put all this together yourself. So the education process has been a little bit shortcutted. I read about 3 or 4 articles every morning from Seeking Alpha, and that's my research for the most part. So that's the big deal. But other than that, the other big deal is that if you pick, well, the reason the site is called Seeking Alpha, alpha means beating the market. Beta is the market. So if you're buying an S&P 500 fund, you're buying the large cap stock market. So an S&P 500 fund, they're going to put all the stocks that are in the S&P 500, and you're going to make almost exactly the S&P 500 index. So as with anything else, there are some dogs in there, and it depresses your return a little bit. But really, you can do very, very well by just investing in index funds and forgetting it and checking on it once a year. That's fine. And you don't want the research and all that. But seeking alpha means you are seeking alpha, which is a return higher than beta. And all of the authors on there will say, if you do some research and you're careful at picking your stocks, you should be able to beat VNQ, which is the index fund for REITs, by a substantial amount. I think I put in here that really go in and start buying individual REIT stocks at an absolute minimum. If you're careful at picking stocks, you should be able to beat the REIT index fund by 200 to 300 basis points, 2 to 3%. My REIT portfolio is returning, I think it's 17.7%. with individual stocks. So I'm beating beta by quite a lot. So those are the two main differences: higher return if you're careful at investing, and the time that you would otherwise have to spend on research.
So thanks, Roy. Unfortunately, we're not going to have any more time for questions, although I know there are several in the Q&A. But thank you so much for all of that information. And I'm going to hand over to Pam.
Great. Thanks, Nicola. Thank you, Roy, for sharing all of this amazing wisdom and insight. And if you will stop share, I have a few slides I'd like to share with our participants today.
I will, and it was my pleasure. I enjoyed this. I hope that the information is useful to the people who are tuned in.
Great. Thank you. Well, just to signal what is coming up next, we have some really fun and exciting topics coming. Next time, the third Thursday of the month, we are going to be talking about harnessing the power of mobile data with faculty member Michelle Andrews. That'll be followed by several other very diverse topics: global supply chain innovations, examining COVID-induced lifestyle changes. Is that habit or just a trend? Looking at the food delivery industry with Dan McCarthy and the rise of virtual social technologies. Also want to highlight, as always, some of our upcoming courses. And I especially want to draw your attention to AI and machine learning for business, because so much in the competitive world today is depending on our ability to stay ahead with data and analytics, informing our strategies, informing our decisions. We also always have our amazing leadership courses: managerial leadership, executive communications and leadership presence, and leading and inspiring change. We invite you to our website to learn more about that. A quick reminder to complete the leadership development survey and be entered for a chance to win one of two $250 Amazon gift cards. And as always, we really look forward to reading your feedback on your key takeaways from our sessions. So in your browser, a quick survey will pop up, and we hope that you'll take just a minute or two to tell us what you liked best about today's webinar and any other comments you'd like to share. With that, we hope you will enjoy the rest of your day today, and we look forward to seeing you back here on the first and third Thursdays of every month. Take care and have a good day.